Hi, I'm Christian Magoon, founder and publisher of ETFs.com. Welcome to 2012. We're going to do a quick segment here on 3 reasons you shouldn't overlook India going into this new year. You know, if you were an investor in India in 2011, you felt a lot of pain. India ETFs were off anywhere from 25 to 55%. Primarily, this is due to the European debt crisis. And the first reason we're going to highlight that you cannot ignore India is that there may be a bounce. The last time markets really took a risk-off mentality was 2008, and Indian markets lost 50% of their value. If you would have abandoned them at that point, you would have missed out on 2009, where the markets were up over 70% that year. So stay tuned for kind of a solution to this European debt crisis, or even more certainty surrounding it. If that's the case and risk on starts to happen, India could have a similar bounce like it did in 2009. Second, it's the economy, stupid. There's a lot of internal issues India's had in their economy, and that's exasperated the problem. So when you look at one of the chief issues, it's been inflation in India. Since March 2010, the Indian bank, the Reserve Bank of India, has raised rates 13 different times to curb inflation, which has been almost double digits. In fact, in the food category, it has been double digits, almost 12% year over year as of this past October. However, recent data is showing that inflation is slowing in India, and now the Reserve Bank of India is actually starting to indicate that they may actually cut rates. Now, interest rates in India are material. They're about 8.5% right now. In fact, that's 25 basis points higher than Egypt, if you can imagine that. So as interest rates fall in India in 2012, it puts more money into the hands of consumers and businesses, which should stimulate the Indian economy and help markets overall. So number one, the bounce. Number two, it's the economy, stupid. And 3, growth, growth, growth. When you look at India, you have to recognize that over the last 30 years, it's had a consistent growth trend in terms of GDP. India may not grow its GDP 8 or 9% this year, but still, if it comes in at 6 or 7%, it's dramatically higher than most other countries, including and especially developed nations. This type of growth is going to be important going forward and will generate superior returns. If you look at other aspects that are contribute to growth, like population, India is primed for leadership in that space. In 2020, the United Nations is estimating that India will be the largest country in the world. And specifically, when you look at the demographics behind that population, they'll be one of the younger countries in the world. About 50% of all Indians today are under the age of 25. And when you look at areas like technology, they're embracing technology dramatically. In fact, this year, there'll be 3 times more wireless subscribers in India than the entire population of the United States. So India will go to about 900 million mobile subscribers in 2012, when the US has only around 300 million total in terms of population. So India is about growth, and you can't afford to overlook growth in markets like these. So in 2012, don't forget India, because there could be a bounce. The economy looks like it's starting to change. And finally, you can't ignore growth. I'm Christian Magoon for IndiaETFs.com. Stay tuned.